As of late August 2025, Dogecoin Doge trades around 22 cents. This puts it just above the critical $0.20 mark identified by analysts as a make-or-break support. That level has taken on outsized importance because a break below it could signal a resumption of the cryptocurrency's typical Q3 slump. Historically, Dogecoin has struggled in August and Q3. It's rare for it to sustain an uptrend during summer. Yet in 2025, the pattern was broken. As of this writing, the coin is up roughly 28.8% for Q3, led by a sharp run in August of about 10.1%. We therefore find Doge at a crossroads, wedged between bullish technical setups and the shadow of its seasonal volatility. On the bullish side, some well-known technical analysts are pointing to clear buy signals. For example, Ali Martinez highlighted a TD sequential indicator giving a buy after 9 straight red 4-hour candles, implying selling pressure may be exhausted. Parallel to that, chartist trader Tardigrade noted a nearly 2-month cup handle pattern forming. Such patterns generally predict that, after the consolidation handle phase, a strong breakout is likely. He calculated that if DOGE breaks out, one modest target is around 82 cents, based on the handle depth, while the full pattern height suggests a target near $2.18. These levels come from standard measurement rules for cup and handle. It's measuring the depth and adding it to the breakout point. In other words, the chart suggests a potential for a very large upside in a best-case scenario. Similarly, Binance's technical feed Mr.Z ABIH01 flagged the cup handle on the 4-hour chart, noting Dogecoin has formed a reliable support around $0.215 and a resistance zone at $0.235. He even suggested that a decisive close above $0.235 with strong volume could carry Doge toward the mid-$0.20 south before encountering serious sell-side pressure. If Doge clears its near-term resistance, the next hurdles are well known. Analysts often look at Fibonacci extensions as key resistance zones. In this case, the 100% extension from the recent move sits at about $0.2810. Beyond that, critical psychological levels lie near the 30 cents area. Some traders cite the 123.6% and 138% extensions around $0.3017 and $0.3151, with an ultimate 161.8% extension around $0.3386. Each of these could act as a cap on the rally. In fact, Mr.ZABIH01 noted that after clearing $0.235, Doge could first test roughly 25 cents to $0.27 before hitting heavier resistance. Conversely, multiple supports lie below. The 61.8% retracement of the recent drop near $0.2117 and the 78.6% retracement near $0.2011 are often cited as safety net zones. All of these roughly coincide with the 20 cents base, sometimes called Dogecoin's line in the sand. In some, the bullish camp argues that as long as Doge remains above these retracement levels, especially above 20 cents, 21 cents, the uptrend thesis retains merit and targets above 30 cents remain in play. Yet the bear case cannot be ignored. Dogecoin's summer history is treacherous. As one analysis noted, Q3 returns have often been strongly negative. For example, the coin lost 28.9% in Q3 2019, 18% in 2021, and 7 to 8% in 2022 to 2024. Only 2020 saw an unusual summer rally plus 13.4%. Thus, there is a precedent for weakness in this season. The analysts writing about the current chart explicitly warned that if the 20-cent support fails, the correction that began in early August may simply resume. In fact, a recent CCN report cautioned that if bulls lose control, Doge could slide toward 17 cents or lower, revisiting levels seen at the recent month's lows. That would represent a deep setback. Such a drop is plausible if summer liquidity dries up or broader crypto sentiment sours. For example, if Bitcoin or risk assets correct sharply, as occasionally happens after record rallies, we often see meme coins like Doge hit hardest. The technical patterns presume a contained sell-off. If instead there is a general risk-off wave, Doge could break its handle and suffer a steeper fall. Broader market dynamics add to the uncertainty. Notably, during Dogecoin's rise in mid-2025, Bitcoin's market dominance fell as altcoins surged. CoinDesk reported that BTC's share of total crypto cap plunged to multi-month lows. In July 2025, as assets like ETH and Doge outperformed, the decline in Bitcoin-altcoin correlation is a double-edged sword. It fueled Dogecoin's gains in the short term. But historically, a low correlation often precedes violent swings. In other words, when smaller, speculative coins run hot independently of Bitcoin, it often ends in high volatility or abrupt reversals. Likewise, the so-called unit bias effect, where investors chase low nominal prices, for example, preferring one Doge over a fraction of one BTC, has likely amplified DOGE's recent momentum. Combined with social media hype meme mania, Musk, tweets, etc., these forces can produce breathtaking rallies that quickly fizzle. An analyst encapsulated Dogecoin's dilemma. In 2025, it remains a high-stakes beta. Digital asset caught between the gravity of its meme origins and the pull of a more mature market. In practice, unless Doge finds new institutional footing, say via a Doge ETF or corporate use case, its fate will stay tied to trader sentiment. For now, institutional chatter is mostly theoretical, so price action will still be shaped by crypto mood swings. Even on the bullish side, conditions must align perfectly. For the Commandos handle to break out convincingly, volume must expand on the rise above resistance, something that has not clearly happened yet. Daily trading volumes in Doge have been healthy, roughly $2 to $3 billion, but not spiking. Binance's analysis noted that open interest and volume are only modestly higher, not in runaway mode. On technicals, indicators like RSI approximately 58 remain moderate, suggesting Doge is neither overbought nor at a peak panic low. This gives bulls room to run, but it also means the uptrend isn't locked in. If Doge fails to decisively break $0.235, $0.240 on strong volume, analysts suggest it may need another dip to gather strength. The TD sequential buy signal itself is a short-term relief pattern, not a guarantee of a multi-week rally. Traders know that often after a short squeeze, coin may pause or even retrace before any sustained move. What would it actually take for Doge to reach multi-dollar heights? In principle, if Doge can hold above 20 cents in a broader crypto bull market kicks in, the pattern's lofty targets come into play. The 82 cents and $2.18 levels cited by Tardigrade assume a much larger upswing. To put this in perspective, Doge's previous all-time high was only about 73 cents, May 2021. Already a massive move from current levels. So doubling or tripling that to $2.18 would require either an extreme crypto bull run or a game-changing catalyst. Some observers point to the possibility of a Dogecoin ETF or major corporate adoption as potential wildcards. But those remain speculation. One source even phrases these multi-dollar figures as strategic long-term objectives, not overnight predictions. In the short term, most traders agree that the clearest upside targets are the 25 to 30 cent range. Surpassing 30 cents could be the trigger that convinces more participants to chase the rally upward. On the flip side, fundamental realities keep the wild targets in check. Dogecoin's inflation is relentless. About 5 billion new Doge are minted every year. Without proportional demand, even a big rally can be eroded by simple inflation. So far, Doge's utility beyond memes and tipping remains minimal. One analysis bluntly observed, unless institutional adoption significantly grows, Doge's price will continue to be driven by speculation. That means that even if short-term traders push it higher, long-term holders should expect significant volatility. Indeed, if the crucial 20-cent support gives way, analysts warn it could trap many buyers and reopen the correction. Also external shocks, such as a sudden crypto regulation or a meltdown in equity markets, could break technical patterns. In light of this, most strategists emphasize disciplined risk management. Use tight stops below 20 cents, limit positions, and don't over-leverage. Key macro factors are also at play. For instance, in late August 2025, Bitcoin abruptly corrected by roughly 7% from its recent peak. From about $124,000 it fell to $115,000 in a matter of days as concerns mounted over Federal Reserve policy. The much-watched Jackson Hole speech was seen as a potential hawkish signal. That sell-off triggered large liquidations on the order of $500 million in crypto markets, showing how sensitive crypto prices are to macro headwinds. If such a correction in BTC or in risk assets were to deepen, altcoins like Doge could be hit even harder. Crypto traders often say, don't fight the Fed. Currently, markets are concerned about a volatility vacuum around major central bank events. Suppressed volatility followed by explosive moves if policy doesn't meet expectations. So even the best technical breakout is vulnerable to these external forces. In short, Dogecoin's immediate fate will also depend on Bitcoin's stability, interest rates, and global risk appetite, factors completely outside any chart pattern. In summary, Dogecoin is at a critical juncture. Chart teases a breakout scenario that could resume the 2025 rally in earnest, potentially pushing Doge well above 30 cents. From there, 82 cents and even $2.18 loom in the most optimistic projection. However, equal weight must be given to the downside. A failure at the 20 cents 21 cents pivot could reignite last month's sell-off. With some analysts warning of falls toward the mid-teens of a dollar, traders and investors will be watching critical tests. Any close above $0.235 on high volume would energize the bull case, whereas a clear break below 20 cents would embolden bears. All the while, broader crypto trends, Bitcoin moves, altcoin rotation, regulatory news will sway sentiment. As one market observer put it, the next few weeks will show whether Doge turns the corner or slides back. Either outcome will be a telling chapter in Dogecoin's famously volatile story and offer a lesson in balancing technical possibility against real-world risk.